Welcome to lesson 15 of the All Market Trading Framework. I'm Karl Domm, and in this lesson, I'll be diving into a crucial aspect of options trading, position sizing, specifically how to crash-proof your portfolio by managing risk and efficiently using your capital. In the previous lesson, we discussed how using span and portfolio margin can offer flexibility and improve returns by profit stacking and managing trades early. But with greater margin usage comes risks like margin expansion, where your margin requirements can expand in certain scenarios. So what is position sizing? In simple terms, it's determining how much capital you allocate to each trade. It's about optimizing the number of contracts you trade based on your account size, risk tolerance, and the nature of the trade. Getting this right can prevent any single trade from crippling your account. No matter your trading strategy, whether you buy or sell options, follow trends, or trade non-directionally, position sizing is vital. But when selling options on margin, it's especially critical. Poor position sizing can expose you to tail risk, and margin expansion can lead to margin calls. You should never risk blowing up your account due to improper sizing. A common approach to sizing is the fixed percentage method, where you risk a set of percentage of your account on each trade. For instance, if your account balance is $50,000, risking 2% per trade would mean allocating about $1,000 to each position. In the all market profits approach, position sizing goes beyond these standard methods. The goal is to create a crash-proof portfolio that can handle even severe market downturns while optimizing capital efficiency. To do this, I account for volatility expansion, margin expansion, and I run worst-case scenario analysis. Volatility expansion happens during big market events or sell-offs, causing positions to use more buying power, even if they aren't near the money. Then there's margin expansion, where the margin requirement to maintain positions can grow, putting you at risk of over-leveraging and margin calls. Now let's talk through my 5-step process for determining crash-proof position sizing. Step 1. Backtest through one tranche of your structure. First, I backtest one tranche of my trading structure across multiple years and market conditions. This helps me understand the trade's performance and margin requirements. Step 2. Analyze margin usage. Next, I analyze daily margin usage to identify the day with the highest margin requirement, and this represents the worst-case scenario. Number 3. Establish a margin buffer. Then I set a buffer for future market conditions. For example, I aim to keep the worst-case margin usage under 80% of my account's total value. Number 4. Calculate capital allocation per tranche. Once I have the maximum margin requirement and buffer, I calculate how much capital to allocate to each tranche. If my worst-case margin is $8,000, for example, and I want to stay under 80% usage, I allocate $10,000 per tranche. Number 5. Stress test position sizing in different scenarios. Finally, I stress test my position sizing by backtesting it in various market environments. Whether it's a crash, grind down, sideways, or up market, this step confirms that my sizing can withstand all conditions. To sum it up, properly sizing your positions is critical for building a resilient portfolio. It protects your account from major drawdowns while optimizing returns. Make sure to tailor your position sizing to your risk tolerance and account size. In the next lesson, I'll dive into trade entry and execution principles, as it is a crucial skill for any options trader, because it directly impacts the overall performance and profitability of a trading strategy. So click the video on your screen to continue to the next lesson.